Hey everyone, welcome back to Corporate Decoder, the place where we decode corporate filings so you don't have to. Today we are diving into a Form 8K filing from Sonim Technologies, and let's just say their financial situation is about as rugged as their phones are supposed to be. We will look at a new loan they just took out, how it works, and what it could mean for the company's future. Spoiler alert, it involves a trigger effect. The report is dated February 21st, 2025, so let's jump right into it. The main event is that Sonim Technologies got into a loan agreement with Streeterville Capital, a lender, for $3.3 million. This is called a note purchase agreement. It means Sonim issued a promissory note, basically an IOU, to Streeterville Capital for that amount. To get this loan, Sonim had to agree to some rules called covenants. These include making sure they file all their reports on time with the Securities and Exchange Commission, keeping their stock listed on a major exchange, and not issuing certain types of new stock or debt without the lender's permission. These restricted issuances are things the lender wants to control, so Sonim doesn't weaken their financial position. So what counts as a restricted issuance? Basically taking on more debt, especially the kind where the amount of stock someone can get changes with the stock price. The lender wants a say in this because it could hurt their chances of getting paid back. Normal things like bank loans or leases are usually okay though. There's also a most favored nation clause, which is interesting. This means that if Sonim takes out another loan with better terms, they have to offer those same terms to Streeterville Capital. This protects the lender and ensures they get the best deal Sonim can offer. Now let's talk about the loan itself, the promissory note. The face value of the note is $3.3 million, but Sonim didn't actually get that much. There was an original issue discount of $270,000. Think of it like a fee for getting the loan. Plus, Sonim had to pay $30,000 for the lender's legal and other costs. So, after all the deductions, Sonim only received $3 million. If the loan is still around after 90 days, Sonim will also have to pay a monitoring fee. The calculation is a bit complicated, but it basically means Sonim pays more if they haven't paid down the loan by that point. The loan has an interest rate of 9% per year, and the whole thing plus interest and fees is due in 18 months. Sonim can pay off the loan early, but if they do, they have to pay a penalty of 10% on the amount they are paying off. Here's a twist. The lender has the right to redeem or get paid back up to $330,000 each month, starting 6 months after the loan was issued. Sonim has to pay this within 3 business days of getting a redemption notice. However, Sonim gets a little bit of wiggle room. They can defer or postpone one of these monthly redemptions every 90 days, but each time they do, the loan balance goes up by 1%. This is like a penalty for delaying payment. Now, for the part I teased earlier, the trigger effect. If certain bad things happen to Sonim called major trigger events or minor trigger events, the lender can increase the loan balance by 15% for each major event and 5% for each minor event. This is on top of all the other fees and interest. But it can only be applied 3 times for each type of event. What counts as a major or minor trigger event? The report doesn't explicitly define them here, but often these include things like not meeting financial targets, a significant drop in the stock price, or a material breach of the loan agreement. We have to assume those since we are not privy to the details, but be assured they are not good things for the company. If Sonim doesn't fix a trigger event quickly enough, it becomes an event of default. Then the lender can demand immediate payment of the entire loan, plus the extra amount from the trigger effect. They can also charge a much higher interest rate, up to 22%. In some cases like bankruptcy, it automatically becomes an event of default, and the money is immediately due. Sendient Capital Markets LLC was the placement agent for the transaction. This means they helped Sonim find the lender. They got paid $180,000 for their services, which is 6% of the loan amount. Item 2.03 just points back to the information in Item 1.01, confirming that Sonim has created a new financial obligation by taking out this loan. Finally, item 8.01 states that as of the filing date, Sonim had about 5.8 million shares of common stock outstanding. This number is important for calculating things like earnings per share. The filing includes the actual loan documents, which are legally binding agreements. So, what does all this mean? Sonim Technologies is clearly in a tough spot financially. They needed to take out a loan with some pretty unfavorable terms, including high interest rates, fees, and those trigger events. This suggests they are struggling to generate enough cash flow on their own. The most favored nation clause protects the lender, while the prepayment penalty discourages Sonim from paying the loan off early. The trigger events and events of default give the lender significant power if things go wrong for Sonim. On the positive side, Sonim was able to secure funding, which could help them invest in new products or marketing. However, the loan comes with a lot of strings attached, and it could put a strain on their finances if they don't improve their performance. Looking at Sonim's overall direction, it's hard to be optimistic. The company operates in a niche market for ruggedized devices, but they face competition from larger players. Their revenue growth has been inconsistent, and they have a history of losses. One of the biggest risks is that Sonim could trigger one of those events of default, which would put them in a very difficult situation. On the other hand, if they can turn things around and start generating consistent profits, the stock could have some upside potential. Trying to put a price range for it would be speculation because there's not much to base it on, even using metrics such as price to sales ratio. Overall, I'm leaning slightly bearish on Sonim. This loan is a sign of financial distress, and it comes with a lot of risks. While there's always a chance they could surprise us, the odds seem stacked against them. Thanks for watching, and if you found this breakdown helpful, please subscribe to Corporate Decoder for more deep dives into corporate filings.